Hey everyone, Ben Nelson here. Hope you're having a fantastic day. And just want to jump on here. It's time for another real estate market update. What is going on in the real estate market? Lots going on, lots happening. Hot markets all over the place. Definitely here in the Portland metro area, we are seeing just continued crazy activity with multiple offers, really low inventory. Just kind of same that you've been hearing for months here, but we'll dig into the data and take a look at some of the numbers and see if we can, see where things have been and where we might be going from here. So I'm going to jump on a screen share here real quick so I can show you some of the numbers. Here we go. Okay, so here's the latest market action report. We are just trickling down continually on our inventory levels here, 0.7 months of inventory. That's Portland as a whole. Again, as I always say, there's a couple areas of Portland that tend to have a little bit higher inventory levels. And so that actually skews it even more for some of the areas that have even less than that, believe it or not. I'm not going to spend too much time on here. Just point out total market time decreased to 22 days, which is extremely low. Obviously, a lot of things that are priced really well and in very competitive price points, those entry-level price points, if you can call them that, 400,000, mid 400s or less, they are going much quicker than that and very, very competitive. Not that other segments of the market are not competitive, but that is the extremely competitive market. There's just a huge lack of inventory for anything even remotely entry level, which I still can't believe 450 is an entry level house. But you can see the market sale price has increased almost 19% comparing it to May of last year, which is crazy. We're just continuing to see that upward pressure on pricing. Lots of factors there: inventory levels, interest rates still being low. People are getting back to work. So there's a lot pushing those things up. Right down here, I'll show you. So we actually have had more residential listings come on the market this month, which is great. But so how do we have more listings and less inventory, just to not leave anybody behind in the data here? This is a function of how quickly things are selling. So there could be, 5 times as many listings as there are now, but if they're being absorbed just as quickly, then the numbers of inventory level is going to stay the same, because it has to do with absorption and how quickly are they being, being sold. So we're having active listings trickling up, not a lot, but a little bit, and inventory level going down because there are still more sales happening than new listings coming on the market. Yeah, again, that's just trickling up. It actually did trend down a little bit. I'm sorry. So the total listings went up. The new listings for this month were down a little bit, but then you see the pending sales are up, which is why we have a little lower inventory levels versus higher. Again, record closed sales compared to the last 5 years. And look at that, average market time is just in the trough. It is extremely low just because there's so much demand. And that's an indication of demand too. So when you see the new listings are starting to come up, we are seeing more inventory, but the inventory levels in months is going down. That just shows that the demand is there and people are waiting to gobble up that inventory as soon as it comes on. So I'm going to not spend any more time on this. If you'd like a copy of the full market action report, feel free to reach out. Happy to send it to you. Let's jump over to a couple things in the news. So this first one is talking about interest rates. So Federal Reserve officials project rate increases in 2013 or 2023. Wow. So that's still a long ways off, but it tells you what they're thinking. You still have time. It will affect interest rates at some point. They're still extremely low, but this is more of an indication of how they're feeling about the economy. They lower interest rates to try to and prop things up there and buy bonds to try to prop up the economy and when it's hurting. That's why they did that back last year during the pandemic. They wanted to make sure that they kept the economy moving and helped it recover. Whether you believe in that policy or not is kind of beside the point. That's what they do. And so they're saying that they are projecting that we're going to be continuing to strengthen as an economy, and they are projecting to increase rates in 2023. So little ways off. We still have quite a bit of time until then. They're kind of taking a little bit of a wait and see approach before they do anything drastic. But that just gives you a little bit of a idea of their mindset and what they're thinking. I'm going to jump over to the mortgage forbearance again, because we have to. That's definitely something we need to continue talking about and looking at. And this is a good one right here. Mortgage forbearance drops as expiration date nears. There are still 2 million loans still in forbearance, but the number continues to drop. Mortgages in forbearance fell for the 15th consecutive week. So people are starting to figure out, getting out of that. There will definitely be some foreclosures at some point. They're going to continue to kick that can down the road, though, in a number of ways, in my opinion. Extending forbearance, incentivizing lenders to not foreclose, however that looks, I'm not sure. They could just make it really difficult for them, new regulations or restrictions, or incentivize them some other way. But I don't see a huge number of these coming into foreclosure. Will there be some? Yes. But let's remember, in the videos that I've shown in the past, there were over this many foreclosures that came up. Now, of course, this is national, right? There were this many. There were more than this actually that came in just a single year back when we were looking in 2008. So even if all of these came on as foreclosures, we're in a totally different position at this point. We have a smaller number, because I think there were 6 or 7 million over the course of like 3 years during that time. So just gobs of foreclosures coming out. This is a large number, but it's nowhere near that. Plus, we have historically low inventory levels. We are way behind on inventory and building, which I showed, I think, last month, where that gap of needed housing units versus delivered housing units just continues to grow. So I just don't see this as a huge concern in the market. And people have equity. So a lot of people, instead of going into foreclosure, if they can't figure something out with their forbearance, they're going to opt to sell. Yes, that is still inventory, but it's not distressed inventory. And it's not going to hurt our market, in my opinion. And even the ones that do go to foreclosure, that's a long process. So it's not like they're all going to drop on, the market here in the next year or something like that. It's going to take years to work through that for anybody that does end up going to foreclosure. So this is a long tail on it. This is something to watch for sure, just to see what happens. But I don't see it as a threat to our market. I'm going to show just a couple. This is just one website, and take it for what it's a prediction. So take it for what you want. But it's interesting because everybody kind of projects what's going to happen with home prices, right? So if you look at, this is kind of a cool little forecast tool on Zillow. You can type in your zip code, and it'll project what your 1 year forecast of prices going up or down. But any zip code you type in here in the Portland metro area, you see between an 8 and a 10% projected increase over the next year. So 8% here in Newburgh. You put in, say, McMinnville, you've got 8.7. You put in some, in Portland maybe. You got 7.8. So, and that's the case. I checked a whole bunch of them. Anywhere in the Portland metro area, you are looking at somewhere around 8%, give or take a little bit. So is Zillow right all the time? No, of course not. But I've seen a lot of people and a lot of different projections, and you can go on a lot of different websites that they, barring any huge changes, which, obviously when you're predicting, you can't account for, everybody's saying prices are going to continue to go up. So if you're waiting for the bottom to fall out and you're waiting for prices to come down, I think you're going to continue to wait. So everybody thinks prices are going to continue to go up, and I would agree with them. I'm going to show you here on the home price index, and this might shed a little bit more light onto some of that with prices going up. So here is hopefully I pull up the right one here. This is the CaseShiller Home Price Index. Okay, so this shows nationally home prices. So this is back in 2007, 8, the bubble, the crash, and then it shows us up here. Wow, that is crazy, right? Look at how high we are compared to 2006, right? So it looks like we're a lot higher, and that, holy cow, this is like another new peak, and we're going to crash. But if you look at the inflation adjusted chart here, there we go. So there's the inflation adjusted chart, and we are essentially where we were before. So yes, house prices are a lot higher, but adjusted for inflation, they're essentially the same as they were back then. And we have a whole different set of circumstances at play that we didn't have before. As I've mentioned, all of them before, a lot more involvement from the Fed as far as making sure home prices don't drop, because they understand how important that is to the economy. They know that it spurs spending. People are pulling money out of their houses and buying. If the house prices go down, it hurts our economy in a bad way for a lot of reasons. So they have a lot of incentive and they've continued to buy mortgage-backed securities and all of that stuff. So they have a huge vested interest in the housing market. So they're going to continue to prop that up. Yeah, again, you may or may not like that. That's just the way that they are. That's the way that it works, and the way that they interact with the economy. And so we're going to continue to see house prices go up, I believe. And you're seeing the news. You see it, all the things about inflation and how it's continued to tick up. I think that's going to continue as well. We're talking about raising minimum wage. We're talking about we need higher wages. All of that stuff is going to continue to put upward pressure on pricing, because if you, however you feel about it, it doesn't really matter. If you push wages up, it means more people can afford houses that couldn't before, or can afford to pay more for a house than they could before. So that is another continued upward pressure on pricing. Ultimately, we end up in the same spot, 10, 20 years down the road, where wages are unequal to what the cost of housing is, just because of those factors with it. So, and the reason behind that is, so if you really want to dig into the weeds, and I won't get too much into it, but anytime you introduce finance and leverage into a product, it actually, with the intent to make it more affordable, right? Because who can afford to pay for, back in the 50s or whatever, when it was $50,000 for a house? Was it even that much back then? I don't know, but probably less than that back then. But well, that's silly. I shouldn't have to save, for 10 years to buy a house and pay cash for it. Let's do financing. Great, that's great. Well, now you can go buy it for payments, and what does that do? That makes it easier to buy. It makes it it adds to the number of people that can buy it. And leverage ultimately just makes things that are supposed to be affordable. The intent is to make it more affordable, because you can break it into payments. Ultimately, it just ends up making it unaffordable. Look at the cost of housing. Look at the cost of student or education, right? Student loans. Before that was introduced, it was a lot more affordable to go to school. Now, you can pay $50,000, $60,000 a year just to go. That's easy. You can pay way more than that depending on the school that you go to. Cars, you name it. If you introduce financing to it, the cost has gone up. And again, you can like it or not, but that's just the system of debt that we are in. I can't remember who said it, but one of the guys I listened to, he said, or was on another podcast I listened to, he says we're not a capitalist economy anymore, we're a credit economy. He called it creditism, I think. But basically, we don't save and spend, we borrow and spend. So that's what happens when you borrow and spend. You borrow money, it increases and inflates asset values or whatever that borrowed money is being put into. So hopefully that wasn't too high above your heads. I would love to chat with you more in detail about any of that if that interests you. I'm going to share one more screen really quick, just showing the Portland metro area. And if you look, so here's that CaseShiller Index again. This one's a little different. He must have a different filter in here for the inflation because it does show it slightly higher than it was back in 2007. But then if you look at, okay, there it goes. So, there's the curve. We're slightly above or right at or whatever. Now, if you look at Portland and if it loads, see, okay. And now look at Portland's way up here. So as a nation, as a country, we are more down here, right? Right about where we were or just above. Here's Portland up here. Oh my gosh, Portland's more inflated. It's going to crash, right? No, that's just an indication, in my opinion, of, every market is different. You can look at national numbers. That's great. But just because one area is off from the national numbers in one direction or another doesn't necessarily mean, like, if it's lower than the national numbers, doesn't mean like, oh, look, it's poised to continue to grow more because it has to get up to the average, or vice versa. Portland's higher than the national average. So, it's got to come down to meet that national average. Demographics and, migration and all of that stuff comes into play here. And if people are moving to an area, you're going to experience greater growth than the national numbers show, obviously, because you've got more people moving in, you've got more demand, you got extra upward pressure on pricing because of those factors. So hopefully that was helpful to you guys. Hopefully that's interesting to you. Again, if I can help with any of your real estate needs, I'd love to chat with you, whether you're looking to buy your residence, if you need to sell and looking at making a transition, or if you are looking to invest. Again, I love investing. I think real estate is one of the greatest tools for building long-term wealth if you do go about it the right way. And I just love strategizing and helping people get in that investment world and learn the ropes and figure out how to create wealth with real estate. So if I can help with any of that, please reach out, message me, or set up a time in my calendar, and we will talk. And I would love to just connect with you and be of service to you in any way I can. Thanks again, guys. Hope this was helpful to you. Make it a great rest of the day, and we will talk to you soon.